A long-awaited ruling in the U.S. came down yesterday in an antitrust case involving Google. Basically, the judge decided that Google could keep Chrome, the search engine browser, which was a big relief to investors. Let's dissect that decision on Alphabet with Scott Devitt. He's Managing Director, Equity Research at Wedbush. Thanks for joining us today.
Hi, how are you?
I'm good. So one analyst said this ruling was just a slap on the wrist, calling it a home run to the status quo. Do you agree with that?
I do. I think the title of our note was that the government folded like a cheap suit, which means that they folded pretty easily. So it was a very positive outcome, for Alphabet and associatedly, Apple as well, because there's an arrangement where Google pays Apple for placement on iPhones. And so all around, I think it was a very positive for private business and is probably the right outcome in terms of from a competitive positioning standpoint, just given the emergence of generative AI more recently.
Had the judge at all hinted that Chrome might have to be sold, or was that just speculation among people watching?
Well, that was something that was suggested by regulators, as a possible outcome. So Chrome possibly could have been divested or sold, as well as the Android operating system. Neither of those happened. All that the government really said, it was a 230-page document, but the most relevant, I think, component was were those two items, as well as the fact that Google will continue to be able to do business with Apple, which opens up the possibility that Apple and Google could do a deal for Gemini AI search in Google's intelligence offering as well. In Apple's intelligence offering.
What was confusing about this was that the judge said basically no more exclusive partnerships, but still allows the Apple partnership to carry on. Was there a reason for that?
Right. Well, so exclusivity is removed, and then the placement is able to be reviewed by Apple annually. So the reason that doesn't really affect anything is because Apple wants to do business with Alphabet, because Alphabet is the one that can actually afford to pay the $20 billion plus. Any other entity, any AI company, OpenAI or otherwise, that were to agree to do an arrangement, they'd be paying something that's in uneconomic terms because they currently can't monetize traffic in that manner. And so Apple absolutely wants to do business with Google. So the exclusivity being removed doesn't really matter because they're very likely to continue to do business with Google.
Okay, Google also has to share some data. Who will benefit from that?
These emerging, large language model companies like ChatGPT, Anthropic, and otherwise could benefit, but it's interesting because it seems like it's pretty complex and maybe limited in terms of the benefit to these third parties. It's raw data. It's only offered it has to be offered one time. And then it seems like there's still quite a bit of cost involved in actually making any use of the data. So even though Alphabet will likely, protest that, I don't really actually think it's something that's all that significant. But now what you're transitioning into from a debate standpoint is away from this regulatory kind of constraint, that's passed now, and back to, is AI going to be a positive or negative for Google/Alphabet's overall business model? And we tend to lean in the direction of it being a net positive. But I think, that the stocks recovered so significantly, that's going to be the discussion point here for the next, 3, 6, 12 months until it's all figured out.
Yeah. How much of a factor, Scott, was the possibility that AI search could replace the Google search?
Sure. Well, if you remember back to the Microsoft episode many, many years ago, when the internet was emerging and the Microsoft ultimately, missed the internet because of the oversight and the implications of department adjustments back then, it was very likely that at that moment Microsoft was losing, its lock-in with consumers and enterprises. And here, it was interesting, in that document, about 30 or so pages were actually committed to discussing AI. So it seems like the judge was much more open to understanding and actually making a determination based on the way that the industry has evolved. So it's an interesting outcome because while AI is viewed as possibly a threat to Alphabet's business model, it actually was very useful in getting the positive outcome that it did receive overnight.
Have you changed your target prices for Alphabet and for Apple?
For Alphabet, we went from 225 to 245, and then no change on Apple rating, but Dan Ives covers that here and wrote a positive note on it as well. I think with Alphabet, which is the name that I'm more responsible for, that one, you can make the case, you can make a bull case to considerably higher than 245 now that regulatory is behind. Because even with the move today and then the bounce here in the last 3 months, the stock still only trades at 22, 23 times earnings. So it's almost like a company that's been left for dead, has reemerged and come to life that now may have a path to being a $300 stock over the next 12 to 18 months.
What do you think this means for governments, the U.S. or other, to try and curb big tech? What is the message that ruling sends out?
Well, I think, and this has not been priced into other securities today, but I think it removes the regulatory risk that's been perceived in mega caps because of the political change in the administrations and at the FTC in the United States in a very favorable way. So I do think that the base case of investors now goes from being fearful from regulation and potential outcomes of court cases to actually shrugging it off. And that's a net positive for multiples for mega cap technology.
Scott, appreciate you joining us on the program, sir. Thanks for joining us. Scott Devitt is the Managing Director, Equity Research at Wedbush.